Attendees are in listen-only mode.
Good afternoon and welcome to today's ASPA webinar. My name is Amy Omeng and I will be the facilitator today. Again, I know that many of you have joined us in previous webinars and we certainly are happy to have you again today. Some of you are new, so I do want to begin with a few housekeeping items for primarily technology pieces of the webinar. First, if you would address your control panel on the right-hand side of your screen, there are a couple features here to take note of. The first would be the orange arrow. When you click on that icon, that will open and close the control panel, depending upon whether you want to see the control panel. The second feature on that little narrow tab is the square icon. And when you click the square, that will change your viewer mode between a full screen or a window mode, again, depending upon your preferences. And the last icon there in that narrow vertical bar is the hand icon. During Q&A session, this would allow me this would let me know that you would like to ask a verbal question. So related to the questions, question and answer time frame at the end of the webinar, you can also type in questions or comments in the questions pane of the control panel. This allows you to type in your question. At the appropriate time, I can address it to the entire audience and to the presenters. And if you have any issues throughout the webinar, you can type in your issues there and I can address you on the back end. So let's go ahead and move on to the presentation. We are happy today to have Kenneth Hunter and Scott Pattison as our presenters. Kenneth is the Budget and Evaluation Manager for the City of Rocky Mount, North Carolina, as well as a board member and regular contributor for the North Carolina Local Government Budget Association and the ASPA section of Association for Budgeting and Financial Management. Kenneth is a native of Middle Tennessee with bachelor degrees from Tennessee Technological University and an MPA from the University of Georgia. And Scott is the Executive Director of the National Association of State Budget Officers. Prior to that position, he served for 4 years as Virginia's State Budget Director and also headed the Regulatory and Economic Analysis section of the Virginia Department of Planning and Budget. Scott previously served in a variety of capacities in the Office of the Virginia Attorney General and has been an adjunct faculty member at the University of Richmond and recently served on the board of Old Dominion University. Scott's a fellow with the National Academy of Public Administration and currently vice chair of that same section mentioned previously, our section for Association for Budget and Financial Management. So with those introductions, a very warm welcome to both of you, and I will turn it over to you, Kenneth.
Well, thank you, everybody, and good afternoon. This session, ASPA did approach ABFM a couple of months ago about doing another session, and Scott and I thought about it and we decided that we would provide an overview to help fellow public administrators, many of whom may not necessarily be involved in the budgeting and finance field, have an understanding of how state and local budgeting take place, as well as an understanding of some of the challenges and opportunities that we are dealing with now. And what you will see during the course of this session is you'll kind of get an idea of how state and local budgeting occurs. We'll provide an overview of that, as well as take a look at some state and local trends. Scott will present the state trends and I will present the local trends. And a lot of this is nationwide information. And then we'll open the opportunity for you to ask some questions, and then there'll be some polling that will occur during the course of this workshop, as I believe Amy alluded to. So to really understand state and local budgeting, it's important to understand that, in the United States, in our system of federalism, we have different layers of government that are independent of one another in most cases. You have the federal government, you have your state government, in this case, what you're looking at is the state capital of Tennessee, and then, of course, you have your local governments. And if you were to follow the chain, the building to the lower right is actually the Metro Courthouse for Metropolitan Nashville, Davidson County in Middle Tennessee. And each one of these different levels of government have different budgeting processes. And They also, of course, have different responsibilities, different services they provide, and it really does affect the nature in which they approach budgeting, the importance of budgeting, and really trying to better understand how they differ. At the federal level, you could argue that they really aren't engaging in budgeting right now. For many years now, the federal budget has, for the most part, the federal budgeting process has been done, but it's primarily been ignored, large part by politicians, due to the significant issues with gridlock in Washington. There have been spending plans put in place, but they're not budgets in the fact that they are necessarily well planned. They are, for the most part, measures that continue to fund government year after year to a large extent, but really are not providing the level of detail and the ability to make strategic decisions in how to better fund and better operate the federal government. State and local governments are kind of in a different boat. First of all, they either by their own constitutions and charters or because of the federal constitution have to adopt balanced budgets, and they typically have to adopt them within certain sets. Most states at the have rules or laws that apply to budgeting at the local level. They require them to follow certain fiscal year standards, and in terms of when their fiscal years are set, when they have to have their budgets adopted with respect to the fiscal year, or even when they have to have their budget submitted to their city councils or county commissions. And so all of these differences really create differences in how you have to approach budgeting. Now granted, up in Washington, they're budgeting all the time. Each agency has entire budgeting, each cabinet level department has a budgeting staff dedicated to it that is preparing a budget as soon as it has one done. And then, of course, you have certain agencies such as the U.S. Department of Agriculture, the Department of Justice, Department of Transportation, where they're engaging in multi-year funding packages. These, of course, things known as the Farm Bill or the Transportation Bill, of course, are multi-year in scope because a lot of times they're dealing with long-range planning like road construction, certain other strategic initiatives. So where are we with respect to budgeting? Of course, does create some challenges, and I've talked about the issues with federal budgeting, and that has created challenges for state and local governments. The lack of real direction and strategy that's occurring in Washington because of the fact that we are in a situation where Democrats, while they control the presidency, Republicans now control Congress. It used to be split between the Senate being controlled by Democrats and the House being controlled by Republicans, and now starting in January, the Republicans will be controlling both houses, both sides of Congress. That is going to only continue the inability for the two branches of government to be able to compromise or be able to work out collaborative solutions. And that is, of course, going to put state and local governments into significant challenges with respect to those elements of their operations where they have shared responsibility and shared funding from the federal government, whether it be entitlement programs, social services, transportation, even justice and other programs where there is a blending of responsibilities and a blending of asset allocation. That's going to create some challenges, and it has created challenges. There are a lot of programs that have been designed to occur at the local level, and there's just not been the level of support needed to really implement them due to the challenges that we're seeing in Washington. Washington, states, and local governments are all dealing within this next area, and that's trying to figure out within the capacities they have, and this is a challenge at all three levels, but especially at state and local governments, because they're balanced budgeting rules, because the expectations of the Government Accounting Standards Board or GASB, and other rules, particularly what the rules local governments have with respect to maintaining fund balances and how they can issue debt and how their revenues can be structured. Their ability to meet the expectations of their citizens within their available capacities. And that includes, their ability to understand how much capacity, and we mean tax revenue in this case, or how much revenue in total, are their citizens willing to make available through tax increases or through other mechanisms in order to fulfill what the citizens' expectations are. this also, of course, is occurring in an environment where political interests are becoming more polarized. We are seeing less of a moderate tendency in terms of the general political sentiment that, we used to talk about. You had 35% that were one way, 35% that were the other way, and 30% in the middle. Now, in terms of the active political population, it could be 45% on one end, 45% on the other, and only 10% in the middle. And that polarization hurts and affects this argument because you're not really able to come to consensus about what your capacity needs to be and how you can fulfill or prioritize the expectations of citizens. Then, of course, you have really two significant challenges that create further exacerbations because of issues in revenue and the inability to grow revenues in the same way that we were back when the economy was growing at an annual rate of 3 to 3.5%, which was the case from 1980 all the way until around 2006. Now we're growing at an average in the 2 to 2.5% area, and that is, of course, not consistent across the country. There's greater degrees of disparity in growth now that exist between localities, and that creates further trouble when you are dealing with the legacy and the burden created by entitlement packages, not only for citizens but also for employees, and other long-term obligations. And that also includes debt service and even responsibilities for which a government or a jurisdiction is now responsible basically in perpetuity. So all of this, of course, reinforces the fact that budgeting is important to effective planning at all levels of government. First, it's important for us to understand that the first priority that we have when it comes to budgeting is that we have to pay our obligations. We have to pay our legal obligations first. We have to budget for those first. There have been a lot of debates in various states and cities, particularly with how we are now accounting for and recognizing the liabilities created by employment benefits, post-employment benefits, and other entitlements, about are we fulfilling our obligation to make sure that these are fully funded. And of course, in some jurisdictions where they're now having to address these matters, it is causing them really having to look at all the services they provide, and in some cases having to end services, but also in some cases having to go back and change benefit structures, not only for their current employees, but also in some cases for those employees that have already retired. Budgeting is successful when you have the ability to effectively prioritize the needs of the services that you're trying to provide, as well as the objectives that governments try to achieve in order to improve economic development, to try to improve quality of life, and try to move in a forward direction. Budgeting also works when you have realistic projections, not only realistic projections of revenue, which often means conservative projections of revenue with respect to where you think it's going to perform, but also with respect to expenditures, trying to understand that if you're adding services, if you're adding programs, if you're replacing infrastructure or not replacing infrastructure, that all of those do have an impact on your ability to meet the operational cost and deal with those issues. And then last and not least, good budgeting also enables you to better understand the long-term impact of the decisions that you are making now. When you look at what's going on at the federal level, you realize there is not a lot of long-term thought put into many of the policy decisions that are being made, at least at the political level. I want to be careful and say that when it comes to those administrators who are involved in making decisions and trying to develop policies, I do believe for the most part do consider the long-term impact of what they're doing and try to plan accordingly. But as we all know, once in the aspect of the political realm, a lot of times these concepts and ideas are looked at in the short term. So that does create some challenges for us, and at the state and local level, we try to do our best to understand what we are asking of the citizens when it comes to certain initiatives, certain changes in service, certain expansions of service, whether it involves financing or whether it involves increasing operating costs, and giving them an honest perspective of what that's going to mean to their tax bills, what that's going to mean in terms of us possibly having to trade one existing service for a new service. And at this point now, Scott is going to take over and offer us a look at what's going on with state governments at the present and their challenges and opportunities.
Yeah, thanks, Ken. I appreciate people joining this call. What's really good in terms of the timing right now is we just, at the National Association of State Budget Officers, released today our report on how the states are doing from a fiscal and budget standpoint. So let me incorporate some of those statistics in the talk today because I think it'll be helpful for folks. I'm going to start with a state fiscal overview. Budgets for the states, and I believe a lot of localities too, show continued slow improvement and stability. So that's good. They're in the right direction. They're going up, they're growing, and they're stable. This is the 5th consecutive year where we've seen revenue and spending increases. So budgets have been going up. And let me briefly talk about the positive signs. And as I think people on the call know, we're facing a moment in which the legislative sessions will begin for states, for almost every state, very soon. Pretty much most of them will begin next month, and they will be considering the budgets for the next year or 2-year period. So the positive signs that you're seeing are certainly shrinking budget gaps. So there's some stability and structural soundness. Minimal mid-year budget cuts, in other words, less of having to go back and cut agencies after they've already been told what their appropriation is. There are net tax cuts, which certainly is an indicator that there's some money in the system, so to speak, to allow those to be passed. And we have stable rainy day fund balances, which is certainly a good thing. And so I would say there are a lot of opportunities here. I think the tight budgets should be thought of as an opportunity to use performance measures and try to make changes and reforms that may make sense. I think that's pretty critical, given that a lot of elected leaders, a lot of city managers and others continue to be very, very interested in using performance to determine the effectiveness of programs. But we have a lot of challenges, as I know all the folks on the phone participating in the call definitely are living with. We have below average budget growth. We have limited projected revenue gains. We have cost increases in a lot of areas, certainly healthcare being one of them, despite some recent tempering of healthcare cost growth. And then unmet demand in areas such as infrastructure. So let me briefly go over some of the figures because they'll give us a snapshot of where we are and where we're going, and then give us a good idea of what the opportunities are, but also some of the significant challenges. If you look at the general fund for state budgets, you're looking at a situation where the average state budget growth was about 5.5% over the 37-year period in which we've gathered data. But look at those bars there. You can see that the average growth for states and their state budgets since the end of the recession during this recovery period are below average. And I think that gives us a snapshot of the new normal that a lot of us are in. The 2015 budgets are currently expected to grow about 3%, not the 5.5% that's been historical average. The additional money is primarily going to K through 12. There are formulas, court cases, and of course K through 12 is politically popular. Some additional funds are going to university education. Quite a few of the additional monies that are coming into states are going to Medicaid. And then there are things such as a little bit more going to other areas. We call it all other, but it's everything from mental health to state parks, state police, things like that. A lot of other areas, though, of state government continue to be flat, and our expectation is that will continue. General fund spending, again, general fund budgets for states, is still below pre-recession levels if you adjust for inflation. So in nominal dollars, states are back, but if you look at the FY15 two bars, states spend about, in the aggregate, a total of $752 billion per year, and they would need to be spending $771 billion to be back when adjusted for inflation to pre-recession levels. So we're still not back, and if you look at the revenue, the same type of situation exists. If you look at FY15, revenue coming into the states about $748 billion, but we really, really need a bit more of a $763 billion total figure if you want to get back, adjusted for inflation, to where states were prior to the recession. So this confirms how bad that recession was. We are in a period now, for both political and other reasons, that there are net aggregate tax cuts rather than tax increases. This is the second year, FY15, in which states have, in the aggregate, had net tax and fee cuts versus tax increases. And again, as the economy gets better, you tend to move toward a more tax-cutting era. But in addition to that, of course, a lot of elected officials recently have been pushing for tax cuts. So it's also a political as well as an economic issue. If you look at balances, and I think it's helpful to think about what is in the rainy day funds of the states. And it's gone down a bit, but they're still pretty stable. And I think this is a good sign that we're looking at a really stable period for states in which they continue to put money in the rainy day funds. We are seeing, though, that ending balances for states tend to be dissipating a bit, and really that's because states are better projecting how much revenue is coming in to their state budgets. So they're having less of a surplus simply because they're predicting the amount of tax revenue coming in better. We also have another good sign in which you have very minimal mid-year budget cuts so far. You only have 8 states in 14. And then if you look at FY15, we only have 7 states that have gone back and had to cut the budget after enactment. So that's a positive sign. So that's kind of a snapshot. We're in a slow growth, stable period for state budgets. I think one of the implications, though, for locals is there are not a lot of extra funds, and I don't think you're going to see significant, if at all, increases from the states to local aid type programs. Let's talk about the spending by funding source. And I think this is particularly helpful to be aware of because this is total state expenditures, all the money that's coming into the states. And their general funds, which tends to fund a lot, such as K through 12, is only about 40% of state budgets. What's also important to be aware of is well over 30% of state budgets are currently monies from the federal government. So we're very, very dependent on what happens at the federal level. And the expectation is, outside of Medicaid and health care, that the federal funds will either be flat or we'll start to see a decline in federal funds for areas, again, outside of health care. And I think state and local governments need to start thinking about that and being prepared for that. One thing I find particularly interesting is looking at the shifting of those funding sources just since the recession. You've seen a decline in general funds. Again, we're in a slow growth period, and we had significant declines during the recession. In addition, the dependency on the federal government has grown as there's been a decline in the general funds and the tax revenue that states are bringing in. The other thing is you've seen a slight increase in other state funds. What that means is states are more and more earmarking funds, and that's certainly good and bad. If they earmark particular fees for a program, say a state park fee goes to the state parks, it's certainly good for the state parks, but it's money that the state government does not have discretion over to move to areas where there may be some type of crisis or other issue where they need to move money. So I think that's important to be thinking about. The other thing, if you look at total state expenditures by function, and again, this is total state expenditures, this is all monies coming into the states, over a quarter is Medicaid, just Medicaid, which is the health care program for low-income individuals and individuals in poverty. And so that's a fairly significant part of what states are doing. K through 12 education is about 20%, and then about a third is all the other functions of state government, and that could be everything from the accounting functions, state police, mental health, all kinds of other things like that. Now let's look at the general fund expenditures. That's that 40% of the budget that comes from states' own sources of general funds, such as the income tax, sales tax, things like that. And we're in a period right now where K through 12 education is still by far the largest. It's 35%. But we're coming up on 20% of state budgets actually being just for Medicaid. That's not healthcare in its entirety. That is just for that Medicaid program. So that tells you, and there's a word that we've been using in budgeting a lot called crowd out. And in crowd out, we're finding that the Medicaid and healthcare funds is not necessarily a bad thing to do with the money, but it is crowding out funding for other parts of the budget. And you name it, whether it's university education, infrastructure, whatever the case may be, we continue to see this crowd out because the Medicaid funds are growing at a faster pace than the amount of tax revenue that states are bringing in. And that's an expectation that that will continue. And if you look at revenue sources, you will see that states are very dependent. Again, this is in the aggregate. I know some states don't have a personal income tax and some don't have a sales tax. But if you look at the aggregate of states, over 42% of the monies they bring into their general fund are just the personal income tax. And about 31% is from the sales tax. And then other taxes and fees and all kinds of things are the about 20%. So let me make a few comments just finishing up. The first is, I mentioned the trends are positive with 43 states increasing their general fund spending just this fiscal year in 15. Revenue collections are projected to go faster this year over next year, which is positive. But we really are in this situation where additional tax revenue growth is expected to be limited at the same time that the demands for spending are increasing, and that's particularly in critical areas like healthcare, university education, and K through 12 education. And so what that really means is that there's not enough money to go around. And I think that's the bottom line lesson from this data, and it's the big picture that all of us in government have to be thinking about, frankly, every day. And that is, there's not enough money. And so we have to be very effective at explaining why our agencies and departments provide important missions. I think we have to be very strategic in how we're spending the money. I think we need to consider using performance, looking at data, showing that the programs are effective. That's very important. So we're in a situation that fiscal stability is likely to continue, but we have a lot of unmet spending needs. And those are going to persist along with slow budget growth. In other words, very simply put, there's not enough money to go around. And we need to think about how we're dealing with that new normal as we go forward. And while for some it can be a frustrating and depressing situation, it does seem to be, based on projections looking at the data, a continued situation that we all have to deal with. So we have our data at NASBO.org, and now I'm going to turn it back over to Ken.
Okay. Thank you, Scott, for that wonderful report, and I look forward to looking at the data myself here pretty soon. Sorry about that. Crud. So Scott kind of went over the information that they've collected from NASBO. What I'm going to be doing here is kind of looking at a similar set of information for local governments, and this is the annual fiscal condition of cities report that's provided by the National League of Cities. And this comes out a little earlier in the fall. It is a survey, much like with NASBO, that's done of local government finance officers, typically in medium and larger sized cities. The city that I work for, city of Rocky Mount, is one of those participants. What I would like to do now is, Amy, if you will do the second survey question at this point.
Okay, will do. Okay, so as Kenneth mentions, we're posing a survey question here to the audience regarding your thoughts here about how receptive you believe your fellow local citizens are to increasing local tax rates. So let's go ahead and launch that. And I'm going to give you all about 10 to 15 seconds to register your vote, and then we'll share those results. Okay, and I'm showing just about half of you have voted, so let's get some more votes in. And we're getting real close to the majority here. So just a few more seconds and I'll close out this poll, share the results. Let's take a look at the answers here. So we've got 3% saying very receptive, as you might expect. Somewhat receptive, 17%. Uncertain, 9%. Somewhat unreceptive, 31%. And the majority, absolutely not receptive, 40%.
Okay. Well, that's kind of what I was expecting, but I wasn't for sure. I think in some cases you are seeing it, and we'll talk in a little bit. You are maybe noticing it in some of the larger jurisdictions, but from the standpoint of the number of jurisdictions out there, I think that's pretty consistent. The report, the Fiscal Condition of Cities report, offers kind of a good summary, and here's some items from that summary, and then we'll get into some charts. First of all, overall, much like with what Scott said about the states, we are seeing improvement in municipal fiscal condition with respect to both the growth of revenue they have to meet current needs as well as growth in their fund balance and reserves. Many jurisdictions had to draw down from their reserves in order to cover shortfalls and planned deficits that were created by revenue contraction. And there's a lot of different reasons for that. One that some people may not be aware of is that local governments, because they have reserves, are able to invest those reserves. But depending on the state you're in, like for example North Carolina, the means by which you have to invest those resources are very limited. You're focused on security and liquidity first rather than rate of return. So in a lot of cases you're using Treasury indexed funds. And if you look at where Treasury rates have been, particularly for many of the 5 and 10 and 18, 36-month bonds, you'll notice that they have dropped, greatly diminished in their return rate, and that means that for a lot of cities, revenues that they were getting each year from investment of cash have actually gone down significantly. In the case for Rocky Mount, the lost revenue is equivalent to an annual loss of 2 cents of property tax. So it was a substantial drop for us. Also, while revenues are continuing to grow now, you're seeing some growth in sales tax and property tax, mainly due to property value finally being restored, but in some cases due to increased tax rates. It has not recovered to pre-recession levels. In terms of where governments are making some investments, they are trying to do their best to address employee wage issues. Many governments went several years without wage increases. At the same time, employees, like with other professions, were seeing increases in their health insurance costs and other benefits. So they have started focusing on wages. They have focused on adding, or in some cases unfreezing, public safety positions, as well as making some investments. And some of this is because of things that they needed to do to catch up, and some are the cases of mandate. For example, in North Carolina, again, because that's where I'm familiar with, we are now required, because we are a primary E911 dispatch operator, to have a full backup facility. And that's, of course, a couple of $1 million investment. But the idea being is they want to make sure that everybody's got a backup. That's a state requirement, and we don't have much time to address it, but that's a significant investment that we have to make. And also with infrastructure, particularly roads, for those who operate utility systems, utility infrastructure is important, whether it's maintaining existing infrastructure, implementing efficiency measures, energy and other elements, or expanding infrastructure to meet growth. And in some of those high growth cities, two examples here are Raleigh and Charlotte, but also you look at Nashville, Tennessee, and some other areas. A lot of what they're having to focus on with infrastructure is continued expansion to meet growing populations. We also, looking at survey results, is that when revenues have to be increased, the tendency is to increase fees over taxes. That continues to be the case, though we are not seeing as many new fees being created. The biggest challenges that the local finance people are facing have to do with benefits, whether maintaining benefit levels or covering the obligations of post-employment benefits, such as whether it's pensions or health insurance, as well as infrastructure. And infrastructure is a double-edged sword, because at the same time that they are trying to maintain existing infrastructure and respond to needs for growth, the revenue structure by which we pay for most of our transportation needs, which comes from gasoline taxes, has been basically put into a structurally unsound and, I would argue, a permanently unsustainable position because of changes in personal habits, fuel efficiency, the arrival of electric vehicles. All of these factors have created a situation where some kind of solution, this is probably the most important solution that needs to be figured out at the state and federal levels that can impact local governments, is figuring out how to put a new apparatus together to pay for transportation funding. The other factor is that a lot of people, particularly in finance, trying to be conservative, are not certain if revenues will continue to grow. The recession now, it's been 6 years since the recession, 6-7 years since the recession started. In some parts of the country, this recession's over. But the feeling is that, it's time for that period in the cycle for us to potentially go back into a downward or a stagnant economy, which will affect our ability to recover revenues, and at the same time expenditures are continuing to grow due to a lot of outside and external pressures. Looking again, this is looking at tax receipts, and as you can see, sales tax is improving. There have been some jurisdictions that have gone out there and increased sales taxes. There have been some that have passed referendums, and states have been showing that they are directing, from the standpoint of those states that are engaging in tax reform, they are shifting tax burdens from the income tax to the sales tax. You can also notice with property tax there's been some increase in 2014, and a lot of this is due to increases in property values, not necessarily rates. Another thing to point out with respect to sales tax, during the housing boom that you saw in the mid-2000s, sales tax grew significantly because of the impact of the construction industry. A lot of construction materials, some of course were tax exempt depending on tax laws, but in some cases those materials, as well as materials that people bought for their own home, were taxable. When that activity dried up, it did have a significant negative effect on sales tax, as did failure for people to replace automobiles, trying to get more life out of their car, and some other big ticket purchases. Those states that were able to sustain their sales taxes were actually those that were taxing more of their basic goods like food and other needs, as well as those that broaden their tax base into services, which remains a controversial topic. Looking at what finance officers have done, as you can see, there are these indicating factors with respect to concerns or issues regarding the economy, and you can see that really the biggest challenges have to do with some significant cost pressures, like if you can see here, 84% feel that prices and service costs are increasing. A lot of businesses have kept prices the same for an extended period of time or used other measures to offset their own inflationary problems, and now they are finally starting to pass those costs on to governments and to other consumers. There's also been tightening in the supply of services like construction. Several construction companies in a lot of local markets all across the country went out of business, which means you have fewer firms, which means they can charge more when they're looking at bid work, which is encouraging some states now to look at services like design build to try to contain cost. You can see wages as another big factor, again, because not only to try to catch employees back up, but also the issue that particularly municipal jurisdictions have in competition with one another for talent, particularly in public safety and other critical needs. Going over to whether or not certain factors had a positive or negative impact, you can see really the only strong positive impacts have to do with tax-based growth and the health of the local economy. It's good that it's that high from the standpoint of the survey group. However, I would also argue that It is not necessarily as broad of a positive outlook, in large part due to there are a lot of areas where their populations have not returned to pre-recession levels. Their total wages, in terms of wages being paid locally, haven't, and some other considerations. Looking at revenues overall, you can see that that the largest increase in terms of actions taken to grow revenue was with respect to fees. Property taxes were second, and overall we saw the number of fees increase as well, the level of these fees and other taxes. You'll also notice that there was some decrease in property tax rates, and a lot of times that has to do with reassessments. There were some continued decreases in tax base. There are some residential markets that are not picking up. And there were a few that saw some fee level reductions and reduces in the number of fees. I'm going to be very honest, that's probably having to do with some fees that were developed as experimental, like red light cameras and other things that kind of went away as they've proven more difficult, particularly those revenue sources that proved difficult to recover the actual fee because of the nature of how the fee is assessed. For example, some states have tried to catch toll road, tried to run tolls where people don't buy transponders. They issue the toll tickets by mail, and in some cases you have them spending 50 cents to send out a toll statement for 25 cents, and people just aren't paying them. So they're not necessarily bringing in the revenue that they thought they were based on some uses of these various means of paying for infrastructure. From an expenditure action standpoint, you can see 76% of those responded did increase wages. Also significant increases in public safety, infrastructure. There was some adding of employees. That's why you see 33% of the work did see some increase in workforce. 36% added some services. So there's been some growth, but again, it's primarily in those critical areas that did not see a lot of growth or saw declines during the recessionary period. And in some cases, even though they're seeing continued increases in benefits cost, they're not necessarily an improvement in benefit levels. That's still a challenge for many jurisdictions. Now, the other factor, what really matters to a lot of us in finance and budgeting, is making sure that we're growing our reserves, to make sure we have strong reserves so that when downturns occur, we're able to rely upon those reserves to at least hopefully cover the cost in the short term, to avoid tax increases which could put us at a competitive disadvantage with respect to other issues. And as you can see, since 2012, these fund balances have grown. They grew for the second year. Overall, looking at balances of over 20%, 21, 22. A lot of states still have on the books laws about having fund balances of 8%. If you look at those numbers, means they really only have enough reserves to cover 1 month's worth of expenses. In reality, 20 to 25% is best because that gives you 3 months. It also avoids from you having to borrow cash to pay expenses for short terms in anticipation of one-time tax revenues like property tax. If you're keeping your balances within 8 to 10%, more than likely your jurisdiction is having to go out and basically do the government equivalent of a payday loan. Does not have the same issues that payday loans have in the private market, but they're having to basically borrow money to cover expenses for 30 to 60 days while they wait for those taxes to come in. And while there's not a lot of interest paid, there are fees, and of course that is a cost with respect that hopefully you can avoid by having strong enough reserves. The analysis you can see here, I could give you the full link, but you can go to nlc.org for it, but there is a direct link, and when this presentation is made available, you can use that to obtain this information. Last and not least, I just wanted to cover some other things going on. A lot of this is new information with respect to business trends and market trends. One issue that we're seeing is continued concerns about housing volatility. And while we're seeing some increases in values, we're seeing that home sale performance is not consistent. The same is true with housing starts. And one significant factor is, and this is particularly a challenge in those places that have relied upon single-family housing to be their strong suit, suburban areas, rural areas, more detached areas from urban cores. We are not seeing as much single-family development as we're seeing multifamily development. You go into major cities, they're building a lot of condos, they're building a lot of apartments, mainly focused in downtown, in revitalized downtown areas, meeting the taste and the market of younger professionals, and even in some cases now meeting the interest of retirees. 10 years ago, it was looking like retirees were going to move out to the country, live in 2,000 square foot McMansions. Now, because of changes in the economy, they're looking at condos anywhere from 800, some are looking at even smaller ones, 1,200 square feet, so that market has changed. And then you could even go down to the point of, in some cities where people have started this micro house movement of having little homes that could be anywhere from 250 to 300 square feet. Manufacturing and service sector overall, industry growth has continued. Manufacturing trends, as determined by various national surveys, have been up for 18 months. Service sector has been growing for 58 straight months, particularly in the professional services that require educated workforces. And that, of course, then ties to the fact that because these sectors of growth are skilled positions, typically those with college or advanced degrees, these knowledge centers are predominantly staying in what I would consider progressive cities. And that's not to say that they're progressive from a political perspective, though many of them are. But what it's really about is the focus that they put on education, higher quality of life, downtown redevelopment, and some other unique characteristics. Those are where the jobs are going. That, of course, puts challenges on other cities that are now seeing long-term declines due to migration, and they're trying to retain these higher skilled workers to hopefully bring employment there. And there's just not a lot of interest in the service sector, in the professional service sector, to thin out their herd of potential employees or their potential labor markets by trying to move into new areas. There was a significant bump, and it just came out today, with respect to small business sentiment measured by the NFIB. For the entire year, their optimism index was showing declines, and this month it picked up by 12%. Now, it is the holiday season, and that's a good sign, but so far holiday retail activity has not been considered all that great. It's kind of flat. So what exactly changed? Think about it. What has changed that small businesses, particularly those in retail and are dependent upon customer funding, what would you say has been the biggest impact? And honestly, it comes to gasoline. This chart shows you crude oil and gasoline prices for the last 10 years. And as you can see, we are finally back down at levels with respect to fuel cost. These are national averages, so of course there's significant differences from state to state. And you can see that now that our national gas price average is significantly below $3 a gallon, I would say that that is helping to make businesses feel more comfortable, because what they know is lower gas prices means more disposable income for families and for individuals, which means potential for more sales. That has really been the driver for a lot of people from the standpoint of their own personal budgets, because they just simply do not have the cash. So that wraps up my presentation, and I believe we're now going into the area for Q&A.
Yes, thank you, Ken. This is the time when you can certainly we would like to open it up for audience participation, discussion, and questions for the presenters. So in order to do that, you can either ask a verbal question by hitting that hand icon, and I will address you by your first name, or you can type in a written comment or question, and I will address the presenters and the audience with the comments. And we have had some come in during the presentation, so I'm going to start with a couple there. Leo is asking about what limitations are there with respect to unfunded mandates, federal to states to local governments. So limitations with respect to unfunded mandates. And
Scott, you want to take it first?
Yeah, I guess I want to make sure I understand the question. I think that on the one hand, one thing that I think is a huge problem for state and local government, and as they go up to the federal level, is the unfunded mandate issue. And I think part of the problem that we're facing is we have a lot of unfunded mandates, but more than that, the acceleration of the federal government either not increasing a lot of monies to states and localities or actually decreasing them, and we've seen that through the sequester and so forth, means that you're seeing an outright decline in monies, but the mandates are not being changed, and I think that is a huge issue. I know that state and local groups are being very aggressive in trying to tell the federal government, you've got to provide more flexibility on mandates, especially if you're decreasing the funds. Now, unfortunately, the feds have not been open to that or good about that, but I think we need to all be putting pressure on all levels of government to explain that that's a real serious issue, and we've got to continue to raise that issue, because it's just not sustainable to have so many unfunded mandates and have them increasing.
And what I will add to it is what we're also starting to notice is, and this is particular in some states that are starting to see legislative transition from one party to the next, particularly in the Southeast, but also in some other states that have been trying to deal with tax reform. The states, of course, are trying to get their balance sheets in better order, particularly because of the mandates they're facing at the federal level. But what it's also doing is it's requiring them to look at the way in which they share revenue with local governments. And what they're doing in some cases is they're simply taking the revenue away from us, or they are restructuring the revenues so that they are basically capping what we receive at levels that we've received in the past. So the potential for growth in future revenues has been significantly diminished. We've seen that here in North Carolina. I know that that's happened as part of tax reform effort in Kansas. There's, of course, what happened during the start of the Christie administration in New Jersey. So that's been an issue that has affected local governments, because it is now putting the pressure on local governments to have to go back to their citizens and discuss, if our revenues are not increasing, yes, we'll need to reduce services unless you are willing to increase taxes. So it is forcing those conversations. There's a significant one in North Carolina having to do with business license taxing. Obviously, there are lobbying groups out there that are pushing to eliminate business license taxes. They were successful here in North Carolina. Some jurisdictions like ours, it's not a big impact, but when you look at some of the metro areas, that's going to be millions of dollars in revenue that they're going to lose next year. And there was no consideration of how to hold them harmless.
Okay, thank you for that. Ryan has a specific question backing up a little bit to slide 8. He says that you mentioned that states are on solid footing with their rainy day funds. Will they be able to withstand the extra costs associated with Obamacare once the federal government stops subsidizing some of those costs for states?
Well, that's a good question, and there are a couple of things regarding that. And one is that obviously it's not just about the Affordable Health Care Act and Obamacare. It's so much more than that. There's so many complexities to the healthcare market and the healthcare system, and frankly, the complex involvement of government in that there are all kinds of things going on with regard to healthcare. So it's relatively difficult to predict what kind of future costs will occur. That being said, I think we can pretty much agree that costs will continue to go up. I think the question is it higher than the revenue for states? Any additional cost to states, whether it's the additional Medicaid funding, anything that they have to spend more money on, obviously in a limited resource environment that we're looking at, obviously has an impact. So I think that's, to me, what states are looking at is every additional cost. It gets to that crowd-out issue. It means that there's not money for other things.
Right. Okay. Thank you. Another question back to sort of the relationship with state and local budgets. The question is, to what extent in state budgeting generally is direct consideration given to local budgets?
Well, I think that it's discussed during the budgeting process a lot more than local government probably even realizes, and it makes sense because the system is set up that way, because you have so many legislators with so many local jurisdictions, and most states have very, very good associations of the local governments, whether it's the municipal league or whatever the case may be. So I know that those concerns are heard, and I know that the impact on localities is discussed. Frankly, I think it's discussed more by states than it is when the federal government discusses impacts on the states and localities. That being said, there are a lot of competing priorities, and most of the monies that the locals receive is for K through 12 from the states. So a lot of the focus is on that. And during the recession, a lot of local aid for things other than K through 12 was cut, particularly in areas like law enforcement. So given that money is so tight and they start off the top by having to fund Medicaid and health care, and then there's K through 12, which of course does primarily go to localities, but there's just not enough money to go around. And I think outside of K through 12 and certain healthcare programs, I think that states are going to be very limited in the amount of money that they have that they can provide to localities. And again, I think the most important thing is it's not any type of sinister desire to negatively impact the localities. I think it's more that money's just going to continue to be limited.
Okay, thank you, Scott. Time for one last question here. Sarah asks about funding. Okay, so how can you effectively advocate for an increase in services for vulnerable populations when your governor, for instance, has called for the State Department to cut a larger amount than previous years? Providing the services now would enable the state to avoid costly lawsuits later, as well as enable the state to have a say in how those services are delivered. So any insight there that for advocacy there?
Scott, and I'll just say real quick, I think the most important thing, and it can be very difficult depending on the environment in the particular state, but that being said, I think that the thing that really seems to be making a difference in decision making and helps to get some of it out of the political aspects is to really utilize to the extent possible data, information, measures of performance and effectiveness. And some of us who've been around in this space for so many years kind of roll our eyes because some of those programs have come and gone and some haven't been that great about using performance. But we really are in this limited resource environment, and whether it's social services or whatever the case may be, we've really got to have measures of effectiveness to discuss the actual impacts with, whether it's the governor, state legislators, mayors, whoever's making the decisions, that a particular program is beneficial, there's good data to demonstrate it's beneficial, and that it saves money in other ways or down the road, and here's good information and quality data to demonstrate that that's the case.
And this is Ken, and I would just say that it all really depends on the interest of your elected officials. If they show a strategic focus on certain initiatives, either the nature of your program or the ability that you have to frame your argument in the context of their interest is really the key. It's as much true at the state level that I've observed as it is at the local level. The local level is stronger because there's more direct relationships between elected officials and the public, and so there's more flexibility, and certain politicians, particularly council members and mayors, will be very specific about what their focus is in terms of the general idea. But when you can frame that reference into something that they are concerned about, it works. Unfortunately, if it's not framed in that reference, then they're going to look at it and go, no, and it doesn't matter what maybe their own beliefs are. They're not necessarily going to prioritize that because at the end of the day, most elected officials are focused on something, whether we agree or not. That's not as important. They are focused on a particular interest that they want to serve for the most part.
Right. Thank you. So we are at the top of the hour. If you have any additional questions that did not get answered, you certainly can forward them to me or to our presenters, and we will get back with you. So I want to say a big thank you to both Scott and Ken, experts in this topic. Super timely information, hot off the presses, so very much appreciated that you could do this for our audience today. As you exit the webinar, you will see an evaluation. We would highly encourage you to complete it for us so that we can have a sense of how we can better serve you with future valuable information. So again, thank you, Scott and Ken, and I thank the audience, and we hope to see you at a future webinar. So have a great afternoon.
Thank you.
Thank you very much.
Yeah, thank you.